Welcome to the Commonwealth Home Ownership Podcast, the real estate investing podcast for Canadians. Whether you're a seasoned investor or just getting started, you've come to the right place. If you're looking for a way to take control of your life through real estate investing, stay tuned and be sure to join us at cwho.ca, your hub for all things real estate investing in Canada.
Everyone, welcome to another episode of the Commonwealth Home Ownership Real Estate Podcast. This is another episode of Mortgage Mondays. I'm Phil Wong. With me, as always, is Brad Price, and joining us again is Kim Nguyen. Hey, Kim.
Hey, guys. How's it going?
Hey, Kim.
Excellent.
Good. So, Kim, what's been happening in the mortgage world in the last couple of weeks? It's been a lot of headlines.
Busy to say the least, guys. And it's just, I'm sure many of us on this podcast here, like you guys have seen the news release and all in Canada as a whole, like we have had one of the hottest real estate markets for January, February, which is absolutely unheard of because usually January, February are very slow months in real estate. But because of the whole pent up demand and with the low interest rate economy, there's a lot more clients that are making the leap now, right? Those who want to get into home ownership, they find that this is a right opportunity. They're making the jump, they're making the plunge. And again, those who want to move a little bit further out, they're also making the plunge. So what is that? What happens? Your market heats up. And surprisingly, believe it or not, Alberta has heated up. So I've been super busy too. Like it's been insane these days.
Yeah, it's been a crazy ride this last sort of 30, 60 days here
Okay.
in the marketplace. What about what's happening with interest rates? Like we've seen a lot of headlines related to bond yields and news down on the south of the border there in the US about interest rate rises. What's happening in Canada with interest rates right now?
So with interest rates, so there's two segments to it, right? The first segment is fixed interest rates, and then the second segment would be variable interest rate. With the fixed interest rates, usually those are guided by bond yields. And within the past, I would say 2 weeks or so, bond yields have spiked. And again, it's due to what our partners in the South is predicting. And also it doesn't help that we have such a hot market. And because bond yields have rise, right now, what we're seeing is most lenders that have fixed rate offerings, they're increasing their rates as well too. And they're increasing it by about 0.10, so 10 basis points to about 25 basis points. That's kind of what we're seeing right now. Because for bond yields, I'll give you an example. When we were this was just maybe 2 weeks ago, bond yields were roughly around 0.38, hovering around that range. But within a week's period, it went all the way, I think the high was, it went all the way up to 0.97. So really what that indicates is a hot market and, signs of recovery, right? They're just very optimistic about that. So again, with all lenders, they've increased all of their fixed rates. So if you do have a lender right now that's offering you something below 1.79, I would say, it's not going to last, right? Because right now the average we're seeing is between 179 to 189. That's kind of what we're seeing right now in the marketplace. But remember, that's only fixed. Variable, on the other hand, it's kind of interesting because with the variable interest rate, it's led by Bank of Canada. And the governor of Bank of Canada has said it multiple times. They don't want to look at any interest rate hikes until 2023. So if you're a variable rate holder, everything is still smooth. And even just for everyone listening to, there's still lenders right now offering rates as low as 1.29% for a 5-year variable. That's how crazy it is, the little difference here.
Do you think, first of all, what do you think the reason is for the hot market in Canada in the last couple of months? Do you think it's just pent up demand, low interest rates, a combination of all the above?
For sure. I honestly think it is a combination of the above, but most of the studies have actually said that millennials have actually felt more comfortable. They've actually gained a lot more consumer confidence in the market. So because it's such a low rate environment, if this is their opportunity to jump onto a home right now, they're taking that plunge, right? They're going right for it. So I think it is a lot of pent up demand, meaning, the clients that were on the fence about home ownership, that low interest rate just gave them the incentive to just jump and go for it. So will this last? I don't think so. I think it's a little bit of a blip right now, and I think it will settle eventually. And we've seen that. We've seen lenders do their rate hikes, and it seems pretty stable for right now. But again, I don't know what 2 weeks from now can bring, right? The economy is kind of funny. So
And there's a bit of talk about a potential, with the CERB payments ending in April, everything, and some people still not back to work yet. There's still don't know what your opinion is about a potential drop in the market down the road as well after all that happens.
It could be. And there's a lot of economics saying that, the demand for clients who want to work away from or buy a home that's far away from work, the countryside and stuff, they have to remember, like, what if you don't work at that job in the near future? Then you have to sell. Like, what's going to happen then, right? And I
Mhm.
feel like maybe most of the consumers buying right now, they're really, they're not really thinking about that factor, because again, you never know what could happen with your job. If later down the road you find that you're not in the same job right now, and now you're forced to go back into the city, what's going to happen then? So it's interesting times.
Yeah, I think there's another factor that's maybe not so much talked about right now, but that's also CMHC at the start of the pandemic, uh, not foreclosing on people during the pandemic was one of their mandates.
Mhm.
So whereby you would have sort of a, I don't know if you want to call it a raindrop effect or a typical, or drip effect, where you would just have foreclosures being processed as they normally would. You're now having this build up in the background of foreclosures that are essentially pending once the inoculation rate reaches a certain percentage, whereby the government says, okay, well, 70% of the population's inoculated, let's get the economy back to work and everyone's free to go about their business as they please. And all of a sudden CMHC says, oh, okay, that's great. Now we're actually going to process all of these foreclosures that we've had sitting on our desk for however long. And all of a sudden that limited supply with 40%, less listings per month at the moment, all of a sudden comes back on the market in the form of foreclosures available for, whether it be renovation project or flippers out there looking for properties. So the knock-on effect is all of a sudden that supply comes back up, and buyers have more options. And then, also if there's a whole whack of foreclosures that hit the market at the sort of the same time, and renovation or contractors and renovation specialists are out there looking for those properties, not only is there going to be more opportunities, but the negative effect of that is that once they're renovated and back on the market, now there's more renovated properties back on the market.
Yeah.
So that's likely going to make that whole industry a little bit tougher to manage as well. So it will be interesting for sure, Kim. But we appreciate these updates, and we hope that people get value out of the information that you're able to kind of bring to the table. And it's a crazy time.
Yeah, roller coaster ride, you guys. I always say, like, every day is a different day. Like, not predictable at all.
So if there's one piece of advice you can give our listeners at this point, what would that be?
I would say, the biggest thing is, the one thing that I've seen anyways with a lot of my clients coming to me with all this news about, oh, the heated market, interest rates going up. I feel like it creates a lot of panic. And I want to, let all the listeners know, don't panic, right? Just because there is something called sensationalism in the media, and they do like to blow things up a little bit larger than usual. Like, I kept hearing all these news articles being sent to me saying, Kim, oh my gosh, it's going to go up, it's going to go up. But like, if you really work down the numbers, honestly, like, if it's gone up and your interest rate is 1.89, I still think that's a pretty decent rate in my opinion, right? Like, let's rewind 1 year ago, even 2 years ago, our rates were in the three and we considered that a really good rate, right? So, and again, like, don't be so panicked by that. And if you are panicked by that, remember, there's always two sides of the equation. There's the fixed rate and there's a variable. Look at where variable rates are standing right now. Bank of Canada made a very, very clear message. And even if you look at the current rates right now, like, it's still very low.
Mhm.
So Kim, these rates that we're talking about, when we talk about rates of, in the ones, 1.79, 1.89, are these relative to principal residence, or are they also relative to investment property? What do we expect the difference to be?
Usually, like if it's an investment property, then we add like an extra 10 to 15 basis points on top of that. So right now we're looking in the low twos, give or take. But yeah, like that would be, so the rates that I quoted there, like those are primary residence rates. But again, when investment properties are factored in, then that rate gets bumped a little bit, but still pretty competitive rate. And again, there's always the variable side, right? The variable side, again, the rates range. If we're looking at, let's say, an investment property, that range will then bump up to about 1.44 to about 2%, give or take, depending on the lender that you go to. And this is for a 5-year variable.
Yeah, I think there's one really key component to what you just said, and that's if somebody is running numbers on a property, be a little bit conservative with your interest rate calculation. Don't use 1.79% as the
Yeah.
basis of your calculation on the investment property that you might be looking to purchase. But you know, if it only scrapes by at 1.79%, then
It's not a good deal.
you might want to reconsider. Yeah, definitely. You know, you want to be over that 2% mark. I think
Higher,
is
yeah, shoot higher. That's what I recommend too. Like, aim for 3, even though,
Mhm.
that wasn't unheard of once upon a time. But if your numbers work at 3, 3.5, honestly, you're laughing.
yeah,
Mhm.
absolutely.
Yeah, always stress test your portfolio. Absolutely.
So, I mean, is there anything else you want to add to the update, Kim, before we kind of jump on to
Good. I think that's good. A good snapshot of that.
That's
Excellent.
great. So, I mean, it sort of ties into rates because you need to have a decent credit score to even worry about the interest rate you're going to get on the mortgage that you're applying for. If you don't have a good credit rating, then you don't need to worry about what the interest rates are doing. Why are credit scores important for uh, real estate investors when they're looking to access capital or applying for mortgages?
Credit score is one of the first criterias that a lender will look at besides income, right? Income matters, but credit score matters just as equally. So if your score is below 680, lenders won't even consider you, whether it be for a primary residence or an investment property, because usually under 680, there are exceptions to it. Like if we have a good story as to why your score is that low, and that could be maybe you went out to go buy a car loan or get to buy a car and you needed a car loan. Car dealerships are notorious for checking your credit multiple times with multiple different lenders. And every time that they do a hard credit check on you, your score goes down, 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 down. So I've had clients where their score was in the 700s, but because they went out to buy a car, now their scores is hovering in the 650, right? Because they
Wow.
did so many different credit checks. So 680 is the key that we're looking at. If it's below and we have a good story, then we can work with it. But usually another thing to note too is certain lenders, whether you're buying a primary residence or an investment property, if your credit score isn't 680 or higher, you don't actually get a certain set of rates. So something to be mindful of too.
And is that for just below 20% down, or is that for any down
That,
payment amount?
that's pretty much applicable for any down payment. I say 680 is kind of like the number that you always want to have in mind.
Okay. I know that there are different credit rating companies like TransUnion, Equifax, but what goes into what affects your credit score in terms of what factors go into how they rate your credit score?
Like, first thing I want to explain is there's so many different credit agencies. So there's TransUnion, Equifax, and Credit Karma is one of them as well too, that uses like a Borrowell score and a TransUnion. So one thing that you have to remember is every platform uses a different formula, but the general consensus and the general formula is, late payments. Are you making your payments on time? They're taking a look at utilization. So what utilization means is if, let's say, you've got a $5,000 credit card and every single month you're consistently owing near the 5,000, so your utilization is at 100%, even though you pay your bills on time, you make monthly payments, because you're consistently hovering around that amount, your score will actually decrease because of that. Because the way that it looks like in, the way that they do their calculation is you're not responsible with credit because you're always at the 100% limit. But if there was another client where they always owed 5,000 on a credit card, but the limit was 10,000, the utilization is 50%. And that client, even though two clients, they owe the exact same amount, the client with a higher credit limit will actually have a better score. Their score will go up every single month. So utilization is important. The different types of credit is important. So you can't just have credit cards, right? It's always good to have a mix, maybe a line of credit in there, maybe a mortgage in there, car loan, all of that stuff kind of plays into the factor of your score and how long you've had it, right? The longer you've had a certain credit card or credit product, it actually does help you as long as you're actually using it.
Mm-hmm. I'm just on the Equifax website right here now and just going over the different, how they break down how they rate your credit score, how they calculate your credit score. So your payment history accounts for 35% of the weighting in terms of how they calculate how your credit score. Your credit use, your credit limit versus your used credit versus available credit is 30% weighting. Your credit history, how long you've owned a credit, is 15%. Public records, which includes any bankruptcies, anything like that, which we'll go into later, is 10%, and inquiries account for up to 10%.
Yeah, that's why
Yeah.
like the main advice I have is if you're planning to buy a car, buy it after you get a home, right? So
Mhm.
don't buy it when you're about to buy a home because they're so notorious at doing this. And the reason why they do this is because they run through so many different banks because every bank wants to bet for your business, right? And they'll say, hey, like come apply with us. Let's see if you qualify. We'll give you a 0% interest rate for this new car you're about to buy. But again, the more dings that you have on your report, like it's a hefty drop for sure.
Do you know how much your credit score gets dinged every time there's an inquiry? A hard inquiry versus a soft inquiry. I think we can go into those too. But
Honestly, it depends because it depends on what else is in your actual credit report too. So like if let's say you've had really rough credit and you've got some outstanding collections and you do a bunch of credit inquiries like hard hits, your score will drop faster than someone who has like pretty decent credit, right?
mhm.
And the way that it works, I say that the average is between like 5 to 10 points per hit, around it, give or take.
And what's the difference between a hard hit and a soft hit?
So with a hard hit, they're looking at absolutely everything. So this is, I'm collecting all the details and I'm checking everything, the skin and bones of it. Where a soft hit is just, it's very soft hit, meaning they're not looking at everything, just very surface level stuff, but you won't get the full picture. And
Okay.
and just in case anyone's wondering, for mortgages, we only do hard hits, no soft hits. We need to see it all.
And for listeners, for those listening, just so you're aware, every time you pull your own credit score, that's considered a soft hit. So when you pull your own credit score and look at your own credit score, that does not ding your credit score.
Yeah, and you can pull your full report as well, and it's still only classed as a soft hit.
Mm-hmm.
So Kim, I want to back up a little bit here. There's a couple of key points. So when we talk about utilization, and Phil, you mentioned it's roughly 30%,
Yep.
somewhere around 30% of
30%.
the Equifax's criteria when reviewing your credit. So we've all been through those scenarios where we get a letter in the mail that says, hey, you're approved to increase your line of credit or increase your credit card by 5,000, 10,000, 20,000, whatever it might be. And often, people would look at that and say, I'm not increasing my credit because of whatever reason. They think that the bank's trying to scam them out of more money. Well, it's not the bank that goes and spends on that credit card on your behalf. It's you that needs to control your spending. But quite simply, if you are to accept and if you had the ability to increase your credit account, your available credit, that will actually help you when it comes to the utilization. So if you do have a card, let's say you have a $10,000 credit card and you owe $2,000 and the bank says, hey, you're pre-approved, we do not have to check your credit. And I always recommend calling the bank to ask them if they do or not, because I've had letters before which has actually been contradictory on the same letter as to whether or not you are approved or just pre-approved. There's a difference.
Yes.
So point being, make the call to the bank and get them to check. But if you're in a situation where you're able to increase, and you can actually just ask the banks too. Sometimes they have promotional offers where they'll do it for you. But by doing that, you'll actually improve your utilization, which makes you look better in the eyes of the lender. Now, just because you have more available credit doesn't mean you just go and have a free for all at the mall. You still have to manage your own financial situation. But there are certain things you can do to better your credit. Now, the one question I want to go back to is you mentioned 680 being the score that lenders are really looking for the most part. How does that vary from lender to lender? And sort of you've got your A grade lenders and your mono lines and credit unions. Like, does it vary at all?
It does. So usually, so the way that it works in the lending industry is there's three sets of lending. So there's the A lenders, which is your traditional banks, your monolines, which are mortgage only lenders, your credit unions. Then we go into the mid level, which is the B lender, which we call alternative lenders. And then we've got C lenders, which is private lenders. If you want to get the best financing options, you go to the A lender. And usually with them, they're the ones that say you need to have a score minimum 680 or we won't lend to you. But if your score is not at 680, that's when we go into the B lender. With the B lender, their range will go anywhere between I've seen some B lenders go as low as a score of 550, right? 550 to 500, that range up to the 680. They kind of do, all within that space. But if let's say your score is even below 550, like 500 and under, usually is a private lender deal, right? And again, that requires a lot more explanation, like what happened. But yeah, like usually that's kind of the breakdown, right? If your score is 680 and above, you go to an A lender. If it's below that, but not lower than 500, then we can kind of play in the B space. But anything below that is a private deal all day.
Okay. In terms of the difference in interest rate between a lender and a B lender, what are we looking at here?
Usually like so with an A lender, I'll use the same rates that I quoted before. So right now, we'll just use the 1.89 as like an ongoing rate right now. If we were to go to a B lender, then the rates will go between 269 to about 3.5, just depending on the type of property that you're buying. And remember, location is key as well too. But usually we're in that range, like the 269, 3.5. Sometimes it could even be pushed to 4. It just really depends. But that's kind of the range that we're looking at. Then when we go to the private lenders, the C lenders, I guess you would call it, the C bucket, rates will start like the lowest would be from what we've seen now, 4.95 and up. And when I say up, it could be double digits, just really depends on, what is your credit score? What happened? How bad is it?
So on that note, what happens when somebody does have a really bad credit score and they're not in a position to, maybe it's not as simple as just saying, okay, we'll just pay off all your debts and your credit score will jump back up. If that's not an easy fix, and there's no other options, like what happens then?
In cases like that where you've got debt that's unmanageable and it's hurting your credit score, that's when, there's things such as money counseling that comes into play. And that's when, you'll hear things such as the bankruptcy route or even the consumer proposal route or even orderly payment of debt. So if it's the unsecured credit or even a mortgage that's really affecting your credit score and it keeps going down, 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 that is pretty much a way to kind of help you, right? But again, with those actions, like comes some hefty consequences after that, right? So it's there are ways to help you, but again, it may not be ideal as just paying it all off if you have the means, right? If you can do that, that's always the best recommendation.
Okay.
So Kim, sorry, before you jump in,
No,
Phil,
go ahead.
just while it's fresh on the hot on the press. So what is the difference between those three things? The consumer proposal, the orderly payment of debt, and obviously we've all heard of bankruptcy. Like what's the difference between those, Kim?
So again, it's in stages, right? The way that it works is if like at the absolute worst case scenario where you absolutely know you cannot pay your mortgage anymore, cannot pay any of your debts anymore, and you just kind of want to throw in the towel and you're just like, you know what, no, I just can't, right? For whatever reason, maybe medical, maybe a separation, whatever the case is, that's when a bankruptcy is declared. That's usually what happens, right? Clients throw in the towel and they say, you know what, no, I have to declare bankruptcy. And that's when the proceeding, what happens there is with the bankruptcy trustee or the lawyer that you work with, the money counselor that you work with, that's when you're basically giving up all your assets, right? At that point. Now, if you don't want to go down that route, and let's just say maybe the point in time with all your debts right now, you just, again, like you want to make the payments, but again, like there has to be a little bit more structure to it. Maybe you can't pay it all off, but there is some intent to pay some of it off. That's usually when we take a look at the consumer proposal. And then going down a little bit would be the orderly payment of debt. And that's a situation where you have all of this debt. You do want to pay off the full amount. You don't want it affecting your credit score too much, but you do have the intention of paying it all off. That's when you would do the orderly payment of debt. Now, there's consequence to each of these items here, because if you do the bankruptcy, it's severe because your credit report is completely wiped. That's done. With a consumer proposal, again, we treat it almost just as bad as a bankruptcy. With the orderly payment of debt, it gets a little bit better, but again, still kind of treated the same way as a bankruptcy, but not as severe in the eyes of the lender.
So by not as severe, how do you mean?
Yeah, that's a good question. So when I say not as severe, so I'll give you an example. A client who has declared bankruptcy and who wants to go back into buying a new home, they'll most likely have to wait a few years before entering, unless they're comfortable with going with a private lender or an alternative lender. Those are the only two lenders that would take them on right away. But if you were to do something like an orderly payment of debt, what happens is there's still chances that you can get approved with an A lender. And usually the criteria with that would be as long as you've paid off your orderly payment of debt. So as long as you're discharged from that and you have 2 years worth of new established credit, so maybe getting a secured credit card for 2 years, as long as you have that, an A lender will consider you.
Okay. How long after a bankruptcy will an A lender consider you, like after you start building your credit again?
Few years. It's going to be few years. So remember, it stays on your report for 6 years, right?
Mhm.
So again, like most traditional bank lenders, if they know that you've had bankruptcy, they won't touch you until after 6 years.
Okay.
There's some A lenders that may on exception basis, but those are far and none. And especially if a home is involved, then most A lenders are completely out of the picture until that's actually wiped and it's clear and you have a brand new report and bankruptcy is fallen off, right? No one
Mhm.
sees the past anymore.
Actually, that brings me to another question then. Where does a foreclosure fall into all of this?
Yeah, so foreclosure again, when you get to a point where you literally just cannot pay anymore, and again, like this happens where, let's say, even if you go into foreclosure and there's not enough equity in the home, like something like that, where you're going to be short an X amount of dollars owing to the bank, and you just don't have the means to pay it, that's usually when the bankruptcy is applied for, because
Mm.
again, you don't have the means. But usually with foreclosures, though, if there is equity in the property, again, the thing is you want to get it away from the foreclosure stage. Like you want to maybe sell your home before it gets to that part, because even if, let's say, you don't declare bankruptcy, but your home goes into foreclosure, uh, that stays on your credit report, right? And then if a lender sees that you've had a previous foreclosure, meaning you had a home that you literally were like, I can't pay this anymore. When lenders see that, they're going to have a lot of hesitation lending to you, especially if you're buying a new place, because in the back of their mind, they're always going to think, well, are you going to do that to me? If I give you this loan, are you going to stop paying? How
Mhm.
can you pay? Like I just don't, I've seen that you've done that in the past. So, is it going to happen again?
Mhm. Yeah, I've dealt with a rent-to-own client who had a foreclosure on their file, and the bank, or at least when we tried to apply for financing, they were told that banks wouldn't consider them for at least 6 years. So I don't know if that's changed at all.
It's just as bad as a bankruptcy, right? That's why,
Mhm.
like, these things that you got to be really careful of. The one thing that you never want to have is missed mortgage payments and foreclosures. That will really hurt you when you're going to look to buy a new home. Now, if you have like simple collection stuff, I mean, collections are still bad. Don't get me wrong, but like a late cell phone bill that went to collections, or maybe Shaw Cable, you forgot to return a modem or something, and it's on your collections, or a gym membership that went on your collection, that it's still severe, but it's not as severe as having missed payments on your home.
Yeah. So I mean, how long does that stay on your credit file? So if you're saying that after 6 years, 7 years, that you can get approved for financing, is it still on your credit file though? Like, is that something that you have to explain? You're going to get questioned on every single time.
It is. So if it's like missed mortgage payments, that for sure will stay on your account forever. and you will have to explain. So that's why with a mortgage payment, that's the one thing that you do not want to miss. Period. End of story. Like cannot. If you have the occasional, maybe you missed a payment by 30 days or something, just that one time, that's okay. But if we see that you were past your payments by 2 months, 3 months, that kind of stuff, it's very dangerous territory. It stays on your account.
This leads me to a question, Kim. Some mortgages, they will give you a privilege of it's called miss a payment.
Mhm.
What about that scenario? If you contact them and you simply ask them that, or state that you'd like to miss a payment, is that something that gets registered, or it's null and void?
That one is fine. That one is okay because it is a right that you have. Depending on your mortgage holder, that is always a right that you have.
Okay, interesting. Yeah, I find it interesting that, after 6 or so years, they'll get, you can get financing, but it stays on your file for forever, basically. And then the other component to that is, I mean, you get asked anyway when you're filling out typically the application form, there's always a question for any sort of financing. Have you ever filed for bankruptcy or been bankrupt? So, I mean, there's really no way around it, even after that. So it could be 10 years down the road and you're being asked that question. And I'm assuming that, let's just say, for example, you're thinking, well, it was 10 years ago, I'm just going to put no. They're going to find out anyway.
Well, I'll tell you how they find out, right? The easiest thing is, they see your date of birth. So if, let's say, you're 50 years old and we see that your credit report has only been established for 5 years. So you first got your credit card when you were 45. They're going to come back and be like, so what happened? Like, where were you when you were 40? Where were you like the years before? Because in Canada, the minimum age to get credit is 18. So unless you were, maybe you were a non-resident or something, sure, then that story makes sense. But again, like if you've always been a Canadian citizen, born and raised in Canada, and let's say, you're 50 years old and you said, nope, never declared bankruptcy. But when we pull up that file, it says the date that this file officially started was 4 years ago. We're going to look at that and be like, what happened in, the other years? So they'll find out. There's just keep in mind because when you wipe off with bankruptcy, like I said, everything is cleared. So the day that you start credit again, that's your open date.
Is that information still available somewhere in the public record, though?
Always. Yes, it is. It is.
Okay, so if the creditor really wanted to dig, they still can
They
find.
can find it. Yep, they can
Okay.
find it.
Yeah, I think that's interesting, though, about the time period there. Like you say, if somebody's 50 years old applying for some financing and it shows their credit history is only 5 years old, that's going to be really strange, isn't it?
It is. Like it may be like, if you were 25 or something, they probably won't ask you because it makes sense, right? If you're in your mid 20s, okay, sure. Like maybe you're a late bloomer, you just got your credit card now, like that is common. But if you're a little bit older than that, they'll question. There'll be some red flags for sure.
Just out of curiosity, then, is repo men a thing in Canada? If say you declare bankruptcy and you're behind in your debt for paying your payments for your car, your house, furniture, whatever that may be, I've never had to deal with it, but are repo men a thing where people send people out to collect your stuff?
Yeah, it
Oh, yeah,
is.
it
It
is.
is actually a thing. Yeah, it can be a thing. So it just depends, right? So the thing that I always say is it depends how cooperative you are with the whole situation.
Mhm.
That's why you hear these funny stories where people are like, "Don't answer the call, don't answer, don't open the doors." Like it can get up to that stage, and I'm sure like a lot of bankruptcy trustees, like they've seen the whole spectrum. It is a thing.
Okay.
So what about situations where, let's say, an investor owns a principal residence and, I don't know, two houses, but they default on a car loan or, just a personal line of credit or something like that, and it goes to the point where the creditor's like, pay, pay, pay. Now we're going to go to, I don't know what is the term? I mean, it's not foreclosure, or maybe it is foreclosing on a car or a line of credit, but they're going to put in a claim and can they then go after your properties that you own?
They can. But the thing is, you got to remember, so this is a fine line. So if that line of credit and that mortgage is under the same umbrella, so meaning they're at the same institution, right, at one lender or whatnot, Absolutely. Because again, they see that you've got the mortgage. They see that you've been making payments on time. They know that there's an equity stake. If you owe the money, like you owe the money. And again, most banks will go, they can go up to that extent to get paid again, depending on, the amount. So that's why you have to be very careful with that. Just because you're paying your mortgage and everything else doesn't mean that that will offset, the other loan that you forgot about or you just don't care about, because it's, yeah, it's still
Yeah.
debt, right? You still have to pay it.
So what I'm hearing is have different debts at different institutions.
You could, yeah, you could. But again, one thing I always say is if it gets bad enough, guys, no matter, what institutions you have, you could bank at every single bank. But if it gets to that level, they'll, it's one of those things when you owe someone money, and especially if it's a big lender like a bank, they want their money back. So
Yeah, you know what? Just from the talking about the kind of three options, so to speak. I mean, obviously, bankruptcy is definitely the worst one, but it sounds like if you end up in a situation where you're struggling and you're not sure if you're going to be able to avoid bankruptcy, definitely get in touch with somebody, to speak to somebody about it, and see what options you have available to hopefully you can go down the orderly payment.
no,
Hmm.
totally.
And you can see you might have to do it tough for a couple of years, but the end result would be nowhere near as bad as going down the bankruptcy route.
Mhm. And I always say too, one thing is you can't run from it, because the most common mistake is, and I've seen this again too, like I work with a lot of clients that have credit issues, credit bruise issues. And the biggest thing is that, they get scared and they say, well, Kim, I just wanted to run away from it. It was just too scary for me to deal with. I just didn't know how to do it. There's so many companies out there, money mentors, and there's so many bankruptcy trustees and counselors that you can talk to, right? They're not going to gouge you. They're there to give you advice. So the thing that you want to do is you have to be in front of it and you have to be on top of it, because when you run away from it, in the creditor's eyes, they're thinking that you don't care. And again, they can just be as aggressive, right? You're just making things like harder on yourself. So when you're in that stage where okay, this is unmanageable, like I don't let it get worse than it already is. Like try to, nip it as early as possible. Like if you have any sense, get on it right away.
Hmm. I believe Money Mentor is actually a nonprofit organization, is it not?
Sure. Yeah, they are.
Okay.
Yeah.
So
So
yeah.
one thing Phil and I always harp on with investors. I mean, new or old investors, it really doesn't matter, but that's just ensuring that you have a reserve fund for each property. And if you don't have a reserve fund, you have a backup fund that is unrelated, but you have access to money somewhere, somehow, should you need it to cover expenses. Because especially the more property you get, really the more backup capital you need.
Mhm.
It's that simple. So whether you use one bank account for all properties and whether it's under a corporation or however you set that up, whether it's a separate bank account for each property, as a real estate investor, you really need to make sure that you're covered for at least a few months. So we always go on about it, but this is even more so. Having this conversation, just it makes me think about it even more. Is always in the back of my mind, I'm like, hey, how much do I have in all some accounts? I have more than what I would typically allow. Some is right on the money. Some is a little bit low, but I know that property cash flows well and it'll be back there right away. So, but I'm always cognizant of it. Phil and I are always talking about this, and we're always talking to new investors about it, but always have reserve funds set up so that you can avoid situations as best as possible. Bad situations as
Mhm.
best as possible.
Yeah, the more properties you have, the more important to have a reserve fund. Just because, I mean, if you have one property, yeah, you can probably float that extra $1,500 a month. But when you have 10 properties, like, are you going to be able to float 15 Gs a month? Like,
Yeah.
it's going to be a lot tougher, right? So it's super important to have that reserve fund. 3 months, at least, typically 3 months of expenses if you can.
Mm-hmm. Mm-hmm. Awesome. Well, so Kim, you get last word. What would be the last piece of advice that you would give to people that maybe experiencing some issues with cash flow and might be concerned about their credit?
Mhm. So if you have any concerns about cash flow, and especially if you're an investor, or even maybe you're not an investor, maybe you're a homeowner, reach out to your bank or mortgage professional, or any financial advisor that you have, just to see if there's any way that you can reduce it. If you do have a mortgage, there's lots of different tools that we can take advantage of, such as maybe extending your amortization to make your monthly payments and your monthly obligations a lot lower, so that could help you in the interim with your cash flow. Or even maybe it's setting up like a second position line of credit, just to give you that little buffer, right? Maybe we can use that to pay out the unsecured debts that you have, all the credit card debts, to then make your cash flow a little bit manageable. Because again, with credit card debt, you got to pay 3% of the balance every single month, and that can add up. But if you get a second position mortgage on your home and consolidate everything, the payment is much lower than that. So there's always ways around it. It's just talk to a professional though. You have to utilize their services, and don't be afraid. Like, there's no such thing as a dumb question. Like, there's always ways to kind of problem solve, but just the one thing is, you got to talk to somebody. You can't just let it float by and be like, oh, it'll change tomorrow, because it won't, right? You need to action. You need to talk to somebody about that.
That's great.
Perfect.
So Kim, if somebody wants to get in touch with you, how would they reach you?
Yeah, for sure. So contact information will be in this podcast, but email is always good, or just give me a call. Phone number will be listed below. I'm sure you guys will link it.
Yeah, everything will be in the show notes, so don't worry.
Yeah, so email, phone, even text as well too, right? I'm a big texter, so millennial, can you tell? So just text me. That's fine too.
All right, awesome. Thanks, Kim. Well, until next time, we have a good rest of the evening.
Awesome. Well, thanks so much for joining us, Kim. Appreciate the update.
Hey everyone, thanks for listening. Just a couple items before we head off. We wanted to let everyone know that we're starting our monthly live events again. It's a great place to connect with other real estate investors and to learn from our various guest speakers. They will be hosted on the last Tuesday of every month, and to sign up or find out more, please visit the events page at cwho.ca. I'll see you guys next time.
Thank you for listening to the Commonwealth Home Ownership Podcast. Be sure to check out all of our past episodes and our ever-growing library of content at cwho.ca. Until next time, remember to get out there, take action, and create a life of wealth by design.